Good morning and welcome to the June 2019 webinar from Pearl Planning, Tax-Aware Investment Strategies. I'm Melissa Joy, founder and president of Pearl Planning, and today we're going to be discussing important topics for all investors who have taxes at issue, which is everyone. And on our agenda, we want to first understand your current and future tax situation. That's very important because your tax circumstances are key to your decision making. And then we'll do some comparisons so you can understand how your tax bracket relates to taxation within investing. Then we'll detail some types of accounts and their tax characteristics, followed by the meat of our conversation, which will be about strategies that can help you to reduce taxes while you're an investor. So thanks for joining us, and let's dive right in. So you may or may not be familiar with these current tax rates because they changed recently, and we've really just completed the first year where these new tax rates are effective. And of course, everyone's tax circumstances change over time, so you can't make an assumption that you are constantly at the same place when it comes to taxes. So here's a review of tax rates as they stand today. We've got the tax rates and where they fall into place, depending on whether you're married, filing jointly, or single. Of course, these aren't the only filing statuses, so you'll want to make sure that you understand what fits for you. There are different and higher tax rates often for those who are being taxed on an estate or a trust account, and that's for permanent irrevocable trusts typically, not revocable living trusts, which often fall back to the original tax rates. And then capital gains rates are on their own schedule. It's sometimes difficult to keep track of. They're often or typically lower than ordinary income rates, which we see on the left-hand column. But you can see here how the tiers fall for married, filing jointly, single, and estates and trusts for capital gain rates. And surprisingly for many people, there is a 0% rate in capital gains, as well as a 15% rate for long-term capital gains, and then eventually a 20% rate. And then we have the Medicare surtax that came along with Affordable Care Act, which begins to hit people around $250,000 of ordinary income or $200,000 for single individuals, and that factors in as well. So how does this information, and I want you to really think about your circumstances from year to year, because if there may be years where you're either high or low, and recognizing that is critical to effective wealth management and strategies that you can do in conjunction with your tax professionals and CPAs, as well as with your financial planner. And I hope you're able to, that's part of the point of this presentation, is to help empower you to know when it's time to have a conversation about taxes, which is often. Okay, so let's look at some examples. And right here I have given a generic kind of illustration of what taxes might be if you lived in the state of Michigan, which has a 4.25% income tax rate. And you're maxing out your income, so you're back in those previous brackets. You're way up here, a married couple, over $600,000 of ordinary income, over $500,000 if you're single. And in this case, we're assuming you're married, filing jointly. You have a very high income, and so thus your total tax rate may be, in this generic illustration, 45.05%. Now, when it comes to different types of investments, it's important to know that everything doesn't fall out as 45%. So with this illustration, we're going to actually show you where you might be given different types of investments. And I think this is a great way to illustrate some of the decision making that comes into pulling together a portfolio for an investor in real life. When you don't just have smooth sailing, you have tax headwinds, and certainly there can be tailwinds as well. So here is the tax on an in-state, a Michigan municipal bond. If you lived in the state of Michigan, you have a 0% tax rate on the interest that you earn, whereas for an out-of-state municipal bond, you had a 4.25% tax, all the way to other in corporate bond investments or other bond investments that aren't government bonds or municipals, and those go up to 45%, right back to that top tax rate. Same for dividends. So a non-qualified dividend would have that 45% rate, but you get a little break if you have a qualified dividend income that goes down to 28%. Here's your capital gains rate. If you sell something within the first year, you're going to be paying a 45% of your gains, whereas it breaks down after 12 months and a day to 28% for your long-term capital gains. And then when you withdraw things from a 401k or a traditional IRA, you're going to be taxed at more than 40%. Whereas if you had money that you're withdrawing from a Roth account, you get no taxes. So you're all over the board, but those taxes would be relatively high. This is, the biggest kind of example for a state of Michigan resident married filing jointly. So then let's look at a comparison. If your family is married, filing jointly, lives in Michigan, but they're making their annual taxable income is $75,000 a year, then the tax rate is around 12% federal plus 4.25% for state, and the total tax rate goes from that 45% down to around 16%. And how does that play out with different types of investments? Well, you are 0% again for municipal bonds, but it might not be appropriate to invest in municipal bonds at this rate. You only pay 16% of the taxes of income from other debt instruments that are not government instruments or municipal instruments, which is much lower, and then you're going to need to compare the yield to decide if it might be a good idea to own municipal bonds. Your qualified dividends only pay taxes at around a rate of 4%. Short-term capital gains are going to be at that tax rate of 16%. Long-term capital gains, because there's that 0% portion, only 4.25%. Important to know. And then when you withdraw from your IRA or 401k, assuming that you don't have a penalty involved and you're at the right ages, then it's at that tax rate of 16%. Roth 401k withdrawals back at 0%. So this is important. And I find so many times that investors are receiving financial advice in a vacuum without taxes in mind. And I want the advice that they receive and the management that they receive to be appropriate for their circumstances, because it can be very different depending on what tax bracket you're in, and you may be in different tax brackets over your lifetime. Now, all of these are generic illustrations. You can't just plug in a generic illustration and exactly have what's occurring for you. So this is all of the disclaimers reminding you that this is not your circumstances. This is a generic example. Okay, so where are your investments? Oftentimes, we think of investing in buckets. So there could be a taxable investment bucket, a tax-deferred investment bucket, or tax-exempt investment buckets. And let's go over each. So I often, the taxable investing bucket, often they could be called brokerage accounts, but you pay taxes as you go. So many of those previous examples, the municipal bond investing examples, qualified dividends, capital gains, all of those apply when you are invested in a taxable investment vehicle. So you're paying as you go. It's not always a bad thing because you can be taxed at a much lower rate, and you're only taxed when there's a taxable event. So if you have unrealized gains in investing, you're not going to pay until you actually either realize the gains or something comes out as income. So your tax bracket really matters. That's when you start to save in taxable investments, which I think is critical, especially when you're considering retiring early. If you have long-term needs you're saving up for, taxable investing buckets are often things I see with investors with good investment behavior. But your tax bracket is going to matter. You need to know where you're at with your tax bracket so that there is an overlay of tax sensitivity within the management of your strategy. Tax-deferred investment accounts, some prime examples are IRAs, 401ks, 403bs. These are the traditional versions, not the Roth versions, which we'll get to in a moment. Annuities, deferred compensation plans. These are accounts where you know you're going to pay taxes eventually, but you're not paying those taxes right now. In some cases, well, if you have, so that is tax deferred growth. That's another way to say it. You're not paying now, you're deferring that tax bill to the future. You often pay taxes when the funds are taken out of the accounts, either some or all, depending on the type of vehicle. And you may receive a tax break in some cases, for example, with 401ks and some IRAs, when you make contributions to the accounts. So a lot of elements going into your decision making of putting money in here. This is often the primary savings vehicle for people's retirement funds or in tax deferred investment accounts. And then we have tax exempt investment accounts. Some of these are some of the newer options. So Roth IRAs or Roth 401ks are examples. Health savings accounts, if you withdraw for healthcare needs, medical needs, are tax exempt. 529 plans, when withdrawn for education needs, also tax exempt. So you get growth within these accounts that are similar to the tax deferred accounts. You don't get a tax bill from year to year when the investments grow. The tax decision is made when investments are withdrawn from these vehicles. There are different rules for each of these vehicles in terms of taxability, but you may not have to pay taxes when you access the funds in these types of accounts. So each is important. Oftentimes when you have all three types of accounts, you can have more control over the taxes you pay over time. And again, it matters what tax bracket you're in. It matters what the tax status is of the account that you're using to invest as well. So let's talk about some strategies that you have to reduce taxes while investing. And what I'd mention is when I look at accounts of individuals that I haven't worked with before, I see that it's not always, but in many cases, there is an underserved population where the tax circumstances of the individuals or families are not taken into account as investment decisions are made. And so all of these are examples where I think that it is gets back to an effective strategy for investing that is looking at your net bottom line and your returns, which if you measure returns of investments, always should include your after-tax return if there is a tax bill tied to those investments. So we're going to go through each of these types, and then for those strategies with an asterisk, I'm going to spend a little more time talking about them with some illustrations. The number one thing you can think about when you're investing in a taxable account is to pick investments that typically would have a lower tax cost, and that could happen because of the types of investments that you choose. We showed you tax characteristics earlier of different types of investments. You may also want to select your cost basis method, which I'm going to talk about more, which is just low-hanging fruit in terms of the way that your account is established so that tax decisions can be made better. What does cost basis mean? Cost basis is how you calculate the realized gains or losses of an investment when you sell that investment. And there are multiple accounting methods that you can choose. I'm going to detail some of them later, but what I found over time is that this is just a neglected decision in some cases for investors, either when they're doing it themselves or with their advisor. And like I said, I feel like it's low-hanging fruit in terms of decision making. Also, while individual types of investments may have different tax circumstances, some lower than higher, so do investing strategies. So some investing strategies are really created with the taxable investor in mind, or that with the knowledge that taxes are a thing, and others are less sensitive to taxes. So choosing an appropriate investment strategy, which of course there are many decisions and factors that go into that choice, but taxes can be one, is certainly beneficial. Invest in the things that cost more tax-wise, historically or typically as an investor, in your tax deferred and tax exempt accounts. So if you do have an investment strategy that you don't want to give up, but it has higher associated tax costs, then owning it in a tax deferred or tax exempt account could be an effective strategy to still own what you want to own in a way that would be more tax beneficial for you. Also, when investments go down while they may not be permanently down. It just depends, but they may be down for a while, and certainly the market goes up and down over time. Then you may use a strategy called tax loss harvesting, where you sell an investment that has declined and move into something similar so that you can take advantage of a capital loss. We'll go into that in more detail. Increasing your contributions to accounts that would reduce your taxes, such as health savings accounts or your retirement contributions in traditional 401k retirements. This can reduce your overall taxes while you invest, so your decisions on where and how to save are certainly a factor. When you decide to make a charitable donation or contribution, if you are over age 70 and a half, own an IRA, and choose to do a distribution as a qualified charitable distribution, that's a possibility that could lower your taxes. Or the gift of appreciated stocks, even if you're going to use a check you would have otherwise written to buy those stocks, the same stocks again, are both ways to potentially reduce your taxes, especially as fewer and fewer people are able to itemize because of the tax law changes more recently. And then be proactive, and this requires communication if you're working with professionals, managing your tax circumstances from year to year. So maybe things are changing. You could be retiring early in the year where you don't have income for as long, or changing jobs, which will have considerable impact, or having a significant sale, which is going to boost your tax rate during a year. All of this can be an opportunity to have more effective management if there's communication, and then planning. And of course, it's much more effective to communicate during the tax year, not after the tax year, where you're basically looking in the rear view mirror and reporting instead of strategizing. So don't wait until you're getting ready to pull together your information to file your taxes to talk about what's changed in your life. And then be aware of the tax cost of your investment changes. Just factor in the tax circumstances to your decision-making in your investing strategies. That's something that, as I make decisions for investment adjustments over time for clients, then I'm looking at the potential tax impact to help to evaluate the decision. So that can certainly be an effective strategy from decision to decision. So let's dive into a few of these things more deeply. First, picking investments. I'm going to give you some examples of investments that might have lower tax costs. Of course, any investment is unique. You cannot predict what's going to happen in the future. Past performance does not predict future returns. So all of these are generalized, and but still important strategies for you to understand. Passive investments or indexes may have lower turnover and are often considered to be lower tax cost potential in terms of their strategy. We talked about municipal bonds. These are bonds that are issued by states and municipalities, and they have a lower tax rate associated, or no tax rate, depending on where and how they're invested. And then investments that trade less frequently are often associated with a lower tax cost. So some medium tax cost investment strategies include qualified dividend income. These investments have a lower tax rate than ordinary income rates. Real estate investment trust, same goes. Higher tax cost strategies might include more actively managed strategies. These might be more appropriate to own in some cases in tax-deferred or tax-exempt vehicles, strategies that have higher turnover, and, frankly, just strategies that don't take taxes into consideration may have a higher tax cost than you really need. So make sure that that is kept in mind as you within your investing strategy. Here's an introduction to municipal bonds, and it's showing you the concept of, we call it sounds fancy, but the tax equivalent yield, which is basically taking, typically with a municipal bond, because you get a tax break, the yield naturally, just with the market, is lower. And So what you need to do to evaluate the value of that yield is, certainly there are other factors that can help determine whether it's a good decision to own a municipal bond. So this is not the only factor, but if you know that yield, and this is a yield calculator, I put in the in-state municipal bond yield of 3.5%. And then, all things being equal, here's what you would need to make in other types of investments in order to beat that if you're in a high tax bracket. Now, what if you're in a low tax bracket? Well, municipal investments may or may not be as appropriate for those investors. But if you're getting 3.5% in this in-state municipal bond, then if you bought a corporate bond, you would need it to pay 6.37% in order to have a similar after-tax return if it was yield only for that investment. Wow, that's a big difference, and it's hard to find 6.3% bonds nowadays, so this is something to take into consideration. Again, this is an example with the highest tax bracket. This is not the only decision for every bond investment, but introducing you to the concept of a tax equivalent yield. Cost basis. So I talked about the cost basis selection. This is something that is tracked within your investment accounts if you've purchased investments recently. Kind of a default is first in, first out. That means the first thing that you bought is the first thing that you sell. If you have a bunch of the same thing, let's say that you were buying your company stock every single year, and the company stock has gone up over time. And let's say it just consistently goes up every year. This is a generic example. Things don't typically work out that way. But then the things you bought the very first would have the lowest cost basis because it had a lower price back then. And thus that might, and if you're in a high tax bracket, that might not be an effective tax strategy. I'm using cost basis methods that Raymond James offers. That's where we custody most of our assets. It's different from custodian to custodian, but I often, for higher tax cost people, ask them to look at the minimum tax strategy. This is much more sophisticated than that first in, first out. And essentially there is a set of logic that looks to identify either the biggest tax loss or the lowest tax gain as the decision is made on what to sell. I really like and think it's important that a good decision has been made about cost basis, because that falls through to all of your sales in the future. So it's important to know what your cost basis is in those taxable investing accounts. So tax loss harvesting is more recently. This is June 2019, and in May 2019, the markets pulled back from a beginning of the year, which was pretty stellar if you measured it by the S&P 500. The same went for the second half of 2018. Well, there may have been a time period where something that you originally invested in had a loss, and thus that can either offset gains in other investments that you either want to take or are unavoidable, and you only pay taxes when you kind of aggregate all of the gains and losses from different investments during a year. So here's an example. You sell a stock that has made money for a gain of $10,000. Let's say that we had a pullback in this generic example. In this case, you sold something that lost $6,000. Perhaps you bought something very similar. You can't buy the same thing, but buy something similar so that you don't completely sit on the sidelines for a little more than a month while you need to kind of reset your ownership period so that you can take that loss. And in this example, that would take your gain down to $4,000, and then the taxes you owe at a 20% capital gain rate would be lower than if you had not sold that same stock. So that helps to your bottom line afterward. So that's an example of tax loss harvesting. It's something that can be incorporated into an investing strategy. But again, many times there are missed opportunities if this is not able to be incorporated. Moving on, if you are making charitable donations and you're over age 70 and a half, It's increasingly popular, but still lesser known that you may be able to make a required minimum distribution by using a qualified charitable distribution that goes directly to a charity that you were otherwise going to give to or feel empowered to give to because of your financial circumstances. This can lower your overall tax bill. Same goes in some cases if you gift appreciated stock. So both more sophisticated giving strategies that it's worth to discuss with your financial professionals, your tax attorney, or your financial planner. It just takes a heads up to have a more sophisticated kind of decision-making list that's going to help you overall. This is just a reminder. This is a look at a graph of, I took it as an example out of one of my clients' retirement plans, and this is how we kind of look at people over their lifetimes. Of course, you can't map out what's going to happen over time, but in this example, we've actually considered a reversion back to old tax brackets with the sunsetting of the tax law. We've considered someone who's perhaps going to retire early, and then we look over time at what tax brackets they may fall into, and it's not going to be the same all the time. You'll notice once someone goes back into and takes Social Security, then that might make a difference, but you've got to manage things from year to year, and that can be done with effective planning. So here we are. This is just kind of the tip of the iceberg of some really effective strategies that I think should be employed more often and are just, underutilized, and it takes communication. It takes an effective professional to be thinking about these circumstances. And when I think about what you should be doing, first, know your tax circumstances. So where are you at? And that has a lot to do with the money you're taking in as well as your investments, the money you're earning. But evaluate your tax circumstances, and at the same time, evaluate how effectively those circumstances are being articulated into your investment portfolio. So have an honest conversation with yourself, and if you're working with a financial planner or financial advisor or your CPA, ask them what type of tax planning should be or could be done. So leverage your financial team. Certainly that your CPA or tax professional is an important component. I'm a firm believer that a certified financial planner like myself can be an effective in terms of implementing tax effective strategies. And of course, your attorney too. Estate planning comes into play eventually, and just overall knowing your overall circumstances. And then adjust your investment strategy so that you're able to maximize your after-tax results and adjust them as your life changes, because things don't stay the same over time. So I hope this was an effective introduction into strategies that can be useful for taxable investors and tax-aware investors. If you have questions for follow-up, because we've only touched the surface, I'm happy to help. Here is my contact information as well as important disclosures about today's presentation. And keep in mind that each month with Parole Planning, we offer a free webinar on different financial topics that we think will be useful for our clients and friends of Parole Planning. And you can always see replays as well as other up-to-date financial information at our webpage, paroleplan.com. We have a blog section which includes all of our web replays of our webinar events, as well as up-to-date investment commentary and other information. So thanks again for listening in, and we look forward to talking to you soon.